Most people think financial scandals are rare events, isolated accidents, bad apples in an otherwise healthy system. But history tells a very different story. Over the last 300 years, the same patterns have repeated again and again, wiping out fortunes, destroying trust, and reshaping entire economies. Some of these scandals were driven by greed, others by arrogance, and some by systems so complex that almost no one realized what was happening until it was already too late. Today, we're going to walk through the 10 biggest financial scandals in history. Not to memorize dates or numbers, but to understand the mechanics behind them, because every one of these stories still matters, and every one of them is quietly repeating itself right now. Let's start with a name that became synonymous with fraud itself, Bernie. In 2008, the world discovered that one of the most respected figures on Wall Street was running the largest Ponzi scheme in history. For decades, Madoff promised steady, consistent returns, regardless of market conditions, no volatility, no surprises. And that was exactly the appeal. His clients weren't chasing crazy profits. They were chasing certainty. Behind the scenes, there were no real investments. New money was used to pay old investors, and as long as confidence held, the illusion survived. When it collapsed, the damage reached an estimated $65 billion. But the real lesson wasn't the size of the loss. It was how long it lasted. Decades. Right under the nose of regulators, auditors, and some of the smartest people in finance. And this wasn't the end of the story. It was a warning. Years earlier, another corporate giant fell in a very different way. Enron. In the early 2000s, Enron was considered one of the most innovative companies in America, a symbol of modern capitalism. But behind the polished image was a maze of accounting tricks designed to hide massive debt and inflate profits. Executives used complex financial structures to move losses off the balance sheet, creating the illusion of endless growth. Analysts praised it. Investors trusted it. Employees believed in it. Until suddenly, the truth surfaced. Enron collapsed almost overnight, erasing $74 billion in shareholder value and destroying thousands of careers. The scandal didn't just expose fraud. It exposed how easily complexity can be used as camouflage. But financial madness didn't begin in the modern era. In fact, one of the earliest and most destructive bubbles happened more than 300 years ago. The South Sea Bubble of 1720. The South Sea Company promised enormous profits from trade with South America. In reality, the trade barely existed, but the story was powerful. Politicians endorsed it, celebrities invested, even Isaac Newton got involved. As share prices skyrocketed, rational thinking disappeared. People bought because everyone else was buying. And when the bubble burst, fortunes vanished across Britain. Newton himself famously lost a massive sum, later saying he could calculate the motion of the stars, but not the madness of men. That sentence alone explains more about markets than most textbooks ever will. A similar disaster unfolded around the same time in France. The Mississippi Bubble, driven by John Law, a man who believed he could engineer prosperity through credit and speculation. He created a company tied to colonial trade in Louisiana and combined it with a revolutionary banking system. On paper, it looked brilliant. In reality, it relied entirely on confidence. When trust evaporated, the French economy collapsed with it. Inflation surged, savings were destroyed, and the public's faith in financial institutions was shattered for generations. This wasn't just a scam. It was a national trauma. Fast forward to 1920, and we meet the man whose name defined an entire category of fraud, Charles Ponzi. Ponzi promised investors massive returns by exploiting a supposed loophole in international postal reply coupons. The explanation was complicated. That was the point. In reality, the business was impossible. But investors didn't ask questions. They saw results. Early participants were paid on time using money from new investors. And that was enough. Millions poured in. Until the math collapsed, Ponzi was arrested, ruined, and eventually forgotten. But his idea lived on. And it still lives on today. dressed in new technology and modern language. Not all scandals come from investment schemes. Some come from commodities markets. In 1963, Anthony Tino De Angelis orchestrated what became known as the salad oil scandal. His company claimed to hold massive reserves of soybean oil used as collateral for loans from major banks. Inspectors saw tanks filled with oil and approved the financing. What they didn't know was that most of the tanks were filled with water, with a thin layer of oil floating on top. The deception cost banks and investors over $150 million, and it exposed how trust and assumption can replace verification even in supposedly rigorous systems. Then there's BR, a Canadian mining company that, in the 1990s, claimed to have discovered one of the largest gold deposits in history in Indonesia. The story ignited a frenzy. Stock prices exploded. Investors around the world rushed in. But the gold samples had been salted with external gold to fake results. When independent verification began, the truth unraveled. Billions in market value vanished. The company collapsed, and one of its key figures died under mysterious circumstances. To this day, the BRX scandal remains a textbook example of how excitement can overpower skepticism. In 2008, the world faced something far larger than a single company or scheme: the global financial crisis. At its core were subprime mortgages, complex derivatives, and reckless leverage. Banks packaged risky loans into securities that were sold as safe. Rating agencies approved them. Investors trusted them. And when homeowners began defaulting, the entire structure collapsed. Trillions of dollars in wealth disappeared. Governments stepped in to prevent total collapse. And millions of people lost homes, jobs, and savings. What made this scandal unique wasn't secrecy. It was normalization. The risks were hidden in plain sight. A few years later, another corporate giant fell, this time in the automotive world: Volkswagen. In 2015, regulators discovered that Volkswagen had installed software in millions of vehicles designed to cheat emissions tests. Cars performed cleanly during testing, but polluted far more during normal driving. The deception affected 11 million vehicles worldwide. The fallout included billions in fines, recalls, and lawsuits. But more importantly, it's shattered trust in corporate accountability. A brand built on reliability had chosen deception over transparency. Then came Wirecard, a German payment processor once hailed as a fintech champion. In 2020, auditors revealed that nearly 2 billion euros listed on Wirecard's balance sheet simply didn't exist. Fake accounts forged documents. Years of warnings had been ignored. Regulators trusted the company. Investors believed the story, and when the truth emerged, Wirecard collapsed into insolvency almost instantly. It was one of the largest accounting frauds in European history. And once again, the signs had been there all along. And finally, we return to a pattern rather than a single name. The recurring cycle of speculative manias, from dot-com stocks to crypto bubbles, from meme stocks to guaranteed yield platforms. Each era believes it's different, smarter, more informed, but the structure remains the same. A compelling narrative, rapid adoption, social proof, and a collapse that leaves most participants wondering how they didn't see it coming. What connects all 10 of these scandals isn't technology or time period. It's human behavior. Trust, greed, fear of missing out, and the belief that this time is different. These stories aren't just history. They're mirrors, and in this channel, we're not stopping here. Every one of these scandals deserves a full breakdown. The mechanics, the psychology, the warning signs people ignored. If you want those deep dives, make sure you're resubscribed, because the next scandal won't announce itself as fraud, it will look like opportunity. And understanding these stories might be the only advantage you have when it does.